It's time for Top That Trade. Filling in this week for Phil is Jared Levy, the Chief Market Strategist for Peak American Financial, and Alan Nachman, the Chief Market Strategist for BullseyeOption.com. Here we go, guys, with round number one. Powerhouse with 4.9% GDP growth in the United States. The U.S. is now the leading economic powerhouse. Stocks, however, just hit 5-month lows. Where do you see a door to opportunity?
Alan's raising his hand.
Well, first off, it's 5%.
4.9.
5% GDP, and I'm going to make a rule, Jared. I'm going to say something, and you can't go and but. You just have to look at it from the optimism prism that I look at, and this is very much a positive. The S&P is still 20% off its lows. We've got a lot of positives here. Yes, the stock market has paused and pulled back, and this 4,200 is important on a weekly basis. Let's see how this holds, but technically, if it breaks below, if this is not a fake-out breakout, then 3,800 is actually the next technical target, even with all this good news.
So how about if I add, we'll call it realism, all right? I won't call it pessimism, but let's think about this. Americans right now, they are spending 102% of their disposable income, carrying 102% of their disposable income as debt. Now, that's been on the rise, as we know, and we're all spending more on our mortgages and on food, et cetera, et cetera. Now, the good news is,
you didn't lock in at low rates, Jared? I thought you were a money guy. Did you not lock in at low rates? Did you just buy 8%?
I forgot. I had them on another place. But the point is, Norwegians actually, they carry 247% of their disposable income as debt. So we're not that bad. So I'm in agreement with you. I think that this is a positive. But again, I'm worried about the short-lived, again, we're spending because we have to. Little FOMO still going on.
All right, let's talk about one thing that's important. Obviously, they've taken the rate hike out of the November meeting. It's 99% chance of not happening. But if you look further out, January, there's still a 25% chance. But after that, there's a 75% chance in March that rates will be lower than that. So the market is moving forward. We've got great earnings. And I'm going to say jobs, jobs, jobs. We've had 20 straight months of unemployment below 4% and 161 million jobs now out there, which is above the pre-pandemic.
Are you working for the Biden administration? Is that what's going on here? Are you
158? Numbers, my friend.
Round number two, sugar futures or cane. Which way do you play? Sweet sugar highs.
All right, I gotta take this one. First of all, I'm a chocolate and cookie addict. So this hits home for me in a very big way, But sugar's been rallying now for a while. I mean, it's been like all year, and it's screaming. We've got drought conditions here. There was a poor sugar beet harvest in Europe, rainy conditions in India. The weather's kind of all screwy. But I'm going to play the opposite here. Cane, C-A-N-E, it's an interesting ETF, Securium, I forget how to pronounce it. But I'm actually looking to buy maybe some puts or go short here. I think sugar has a little bit more room to run, but I would actually start to get short here maybe after the Thanksgiving holiday. That's my take, Alan. I don't know. Are you still buying sugar?
Look at it from risk reward. It's rallied from 10 to 28. In the last decade, it's been between 10 and 20. Now, that breakout target's 30, and we're almost there, like you said. Right. Now, one thing that has helped sugar has been crude has climbed back up again, and an ethanol play, because I'm now a sugar beet expert because I was looking at it the other day for some deer feed, believe it or not. But so I understand what sugar beets all about. So they can use sugar beets, for ethanol, and so that's been supportive here recently. So, but I think there's both ways to play. I'm an options guy, so I'm probably looking like you are, Jared, at some point, maybe to see if there's a little bit of a blow off top and see if we can correct a little bit.
Round number three, treasure trove or trap? This hasn't happened in decades. The 15-year zero coupon treasury bond could nearly triple your money at maturity. As traders, is this too good to be true?
Well, the point to be made here is that you can make money with your money. Now, there are a number of ways to do it. You could go into dividend stocks. AT&T pays about a 7 or 8% dividend. If you look at the treasuries, this is amazing that you can get a 5% coupon. Or if you want to go the other route, you're buying a bond at discount that's going to give you that 5%, but you don't get it till the end. And it's just a unique situation. Use the rule of 72. Think about it. 72 divided by 5 is 15. So you can double your money at a simple 5% compounding in 15 years. That's amazing.
Yeah, it's pretty powerful. And, this is the first time, and Al and I, obviously, more on the equity side. This is like fixed market excitement. And you got to give it credit. The past decade has been absolutely horrible for fixed income. People lost money. So this is interesting. I like what you're saying, Alan. And remember, the difference is you can go and clip that 5 or 10 year bond, collect that 5%. That's an easy way to do it. Zero coupon means you don't get paid until the end. It's kind of like the old Series E bonds, if you will. You buy the face value.
But you can sell it at any time, too. So it does have interest rate concerns. But the interesting thing is you and I only studied this to get through our Series 7 test. We never implemented what we used, but now we're putting it to use because there's money to be made with our money. That's great time.
On to the bonus round question for today. The World Series is on. Which team has the bigger payroll, the Rangers or the Diamondbacks?
All right.
The Rangers. I'm going to pick the Rangers.
Yeah, it's got to be the Rangers.
A swing and 2 hits. You both are right. The Rangers have a payroll of $251 million. The Diamondbacks, $119 million. Great job. Mrs. First Dame will be right back.